Welcome back to the deep dive. Our mission here, well, is pretty simple. Take something complex, like a company's earnings report, strip away the jargon, and break it down into insights you can actually use, make you feel informed. Today, we're diving headfirst into UiPath Inc's Q2 fiscal year 2026 earnings. And this isn't just, reading numbers. It's about understanding the story behind them, what's really driving their performance, how they get these results, and importantly, what might it mean for the future and for how you see this company in the market.
That's exactly right. And our approach today, well, it's structured. We've got a 5-part framework. We're taking UiPath's official numbers right from their release
Yeah.
and mixing that with what the market was expecting. The real-time expectations gives you the full picture. Our goal is really to give you that aha moment, help you quickly grab the most important bits without getting lost in every single tiny detail. We'll connect the dots, show you not just what happened, but why it matters for, your view on UiPath.
Okay, let's unpack this. Now for slide 1, the at-a-glance scorecard. Right, kicking us off with the big headline. UiPath. Their second quarter wasn't just good. They absolutely smashed expectations, both revenue and, maybe more impressively, profitability. We're talking total revenue of $361.7 million. That clearly beats Wall Street's consensus, which was sitting around $347.8 million. So right away, that tells you they're executing well, better than the street thought.
Yeah, and what's really fascinating, I think, is how much they beat on the bottom line on profit. UiPath hit break-in GAAP diluted earnings per share EPS that's $0. Now, that itself is a big turnaround from a loss last year, but the number analysts really watched, the non-GAAP diluted EPS, that's what really blew the doors off. It came in at 0.15 cents. The consensus was looking for 0.8 cents, so almost double.
Wow.
That says a lot about their operational execution, beyond just growing sales.
And when numbers like that drop, the market tends to notice pretty quickly, right?
Yeah.
In this case, that beat across the board led to a really positive investor reaction. The stock jumped about, 6.5% in after hours, trading right after the news. Is a clear signal investors liked what they saw? Confidence restored, perhaps?
It seems so. But here's where it gets, for me anyway, really interesting. It's the huge difference between how fast earnings grew compared to revenue. So revenue, up a healthy 14.4% year over year, went from about $316 million to $361.7 million. Solid growth. But their non-GAAP net income, that surged 238%, just jumped from $23.8 million up to $80.3 million. And the non-GAAP diluted EPS we just mentioned, that grew an incredible 275% from $0.04 last year to $0.15 this quarter.
Okay.
I mean, that's not just growth, that's like an explosion in profitability.
Wow, okay, that is a massive jump. So when you see profits growing that much faster than revenue, what does that usually point to? What levers did UiPath pull here?
Yeah, you've nailed the key question. That kind of amplified growth, it usually signals a couple of powerful things working together. First, it's clear evidence of what we call operating leverage. Think of it like this. Once you've built your factory, or in this case, your software platform, you can sell more products without your core costs increasing at the same rate. Your profits start to accelerate much faster than your sales. For UiPath, their non-GAAP operating income, well, it expanded more than 9 times, 9-fold, from $6.5 million to $62.3 million year over year. That's a huge shift in efficiency.
Okay, operating leverage, that makes sense. And the second factor, you mentioned share buybacks. How do they help boost the EPS number?
Exactly. The second big factor is their share repurchase program. UiPath was actively buying back its own stock. Their non-GAAP weighted average diluted shares actually decreased by 5.3%. Went from 573 million down to about 543 million. So you've got this much bigger profit pie, right? And now it's being divided among fewer slices, fewer shares. That directly juices the earnings per share number because each share left represents a bigger piece of those growing profits. It's a pretty direct way to reward the shareholders.
Got it. And just quickly, for anyone listening, what's the key difference between basic and diluted EPS? Why focus on diluted here?
Oh, good question. Basic EPS is simple. Net income divided by the average number of shares actually out there. Straightforward. Diluted EPS, though, is a bit more conservative. It includes shares that could be created from things like employee stock options or maybe convertible debt, stuff that could increase the share count. So think of it as a sort of worst-case scenario for earnings per share if all those potential shares suddenly appeared. The fact that their diluted EPS grew so strongly is really telling. It means the earnings power is robust even when you factor in that potential dilution. That's a strong signal for, long-term investors. Moving to slide 2, the engine of profitability.
Okay, so that's the big picture, B. Now let's pull back the curtain a bit. Look at the engine room. How do they actually achieve that profitability? A deeper dive into their income statement, it really shows these big improvements in efficiency. That seems to be the main story behind that earnings beat.
Absolutely. The margin expansion we saw, it was pretty much across the board. Gross margin improved, both on a GAAP basis that went up to 82.2% from 80%, and on a non-GAAP basis too, which, like we said, often gives a clearer view of core operations. That went up to 84.3% from 83.2%. But the real transformation, the core engine driving profit,
Yeah.
was at the operating level. Their non-GAAP operating margin just expanded dramatically. It went from only 2.0% in Q2 last year.
So you have 2%?
Yeah, barely breaking even on operations. And now,
Yeah.
a really robust 17.2% this quarter. I mean, think about that. Going from just scraping by to making a really healthy profit on every dollar of revenue, that's a massive leap in efficiency. Huge.
And looking at the details, it feels like this wasn't just luck, right? It looks like deliberate cost management. Pretty much everywhere you look, using those non-GAAP figures, like sales and marketing S&M costs actually went down in absolute dollars to $140.9 million from $148.0 million last year. But as a percentage of revenue, that's a big drop, 38.9% now versus 46.8% before. So they got more revenue while spending less on sales and marketing. That's efficiency right there. Research and development, R&D, also down slightly to $61.5 million or 17.0% of revenue. Used to be 20.2%. And general and administrative G&A, that fell too, $40.1 million or 11.1% of revenue compared to $44.9 million or 14.2% last year. So yeah, across the board, they really tightened things up, turning more sales into actual profit.
And that brings up an important point, the difference between GAAP and non-GAAP again. Why focus on non-GAAP here? Well, GAAP, generally accepted accounting principles, that's the official, required standard, includes everything. Non-GAAP adjusts for certain things, often non-cash items or things management sees as one-offs, to give what they feel is a clearer picture of the core business performance. For UiPath, the biggest adjustment between GAAP and non-GAAP operating income was about $78 million in stock-based compensation. That's an expense on the books, but it doesn't actually involve cash going out the door in the same way. So by looking at non-GAAP, you get a better feel for the underlying cash-generating power of the business. And this quarter, that power looked, well, remarkably strong. It lines up perfectly with what the CFO, Ashim Gupta, said. He highlighted their continued focus on operational efficiency. It shows this was, a strategic effort, not just a fluke. Now for slide 3, the engine room business segment performance.
Okay, so overall efficiency is up. Now let's look inside the different parts of UiPath's business. Where exactly is this growth and profit coming from? Which segments are doing the heavy lifting?
Right. If we break it down, it's overwhelmingly their subscription services. That's the high margin engine here. Remember that total revenue growth of 14.4%? Almost all of that came from the subscription services segment. That part grew a really strong 22.5% year over year, hitting $238.4 million. For a software as a service company, or SaaS, that's exactly what you want to see. That recurring revenue gives them stability and predictability. In contrast, their licenses revenue, that was basically flat at $112.2 million. And professional services and other, while it's there, it's still a much smaller piece, about $11.2 million. So the story is really crystal clear. It's about the strength and the scaling of their subscription model.
That's interesting. But just looking at revenue doesn't paint the whole picture, does it? We need to know how profitable each of these segments is. So let's break down the gross profit for everyone. Licenses. Revenue, $112.2 million. Gross profit, $111.0 million. That's a huge gross margin, 98.9%, almost pure profit there. Then subscription services. Revenue, $238.4 million. Gross profit, $200.2 million. Still a very healthy 84.0% gross margin. But then professional services and other. Revenue, $11.2 million. But the gross profit was negative $13.8 million, a gross margin of minus 123.2%. Okay, hold on. Negative 123% gross margin on professional services. That sounds bad. Is that a huge red flag, or is there something else going on there?
That's a really sharp observation, and it definitely jumps out. But no, it's actually not a red flag in this specific context. What that negative margin tells us is that for every dollar they bring in from professional services, they're spending about $2.23 on the direct cost to deliver those services. Things like implementation help, training, maybe consulting. This structure is actually pretty common in enterprise software. Professional services often act as a loss leader.
Like selling the razor cheap to sell the blades.
Exactly like that. Its main purpose isn't to make money directly. It's there to help sell, implement, and make customers successful with the core software products, the licenses, and especially the subscriptions. By making sure customers can actually use the platform well, UiPath drives adoption and locks in that super valuable, high-margin recurring subscription revenue. So the fact that the subscription segment grew so strongly, that 22.5% growth we saw, that's the real proof that this strategy is working. It's driving the overall margin expansion for the whole company. It's strategic, not a flaw. Let's move to slide 4, financial strength and shareholder rewards.
Okay, so operations look efficient. The core subscription business is humming. What about the company's overall financial health? The foundation. Is it solid?
Oh, absolutely solid. UiPath's balance sheet looks really strong. Two main things stand out: low debt and a lot of cash. As of the end of July 2025, they had about $1.52 billion in cash equivalents, and marketable securities just sitting there. A huge cushion. And if you look at their leverage, their total liabilities were around $926.6 million compared to total stockholders' equity of about $1.67 billion. That gives you a liabilities to equity ratio of just 0.56, which is, well, very conservative.
So less debt relative to their equity base.
Exactly. It means they rely much more on equity than debt to fund the company. Think of it like having a big savings account and very little debt. It minimizes financial risk and gives them tons of flexibility for, whatever comes next: investments, acquisitions, downturns.
And having that strong financial position, that fortress balance sheet, as you called it, it must give management choices, right? Including how they treat their shareholders.
Precisely. That strength lets them actively return value to shareholders. If you look at their cash flow statement for the first half of this fiscal year, they spent a hefty $329.1 million buying back their own Class A common stock. Now, a buyback like that does two key things. First, it sends a strong signal from management. They're basically saying, hey, we think our stock is cheap right now. They're investing in themselves. And second, like we touched on earlier, it directly helps shareholders by reducing the total number of shares out there. Fewer shares mean each remaining share gets a bigger slice of the profit pie, boosting earnings per share.
Okay, so the picture that's emerging here, it seems pretty clear. UiPath looks like it successfully made a shift, maybe away from that typical tech phase of just high growth, burning cash, and towards something more like sustainable, profitable growth. They're generating cash now, strengthening the balance sheet, and actively rewarding shareholders. It feels like maybe a more mature phase for the company.
I think that's a very fair assessment, yeah. It looks like a significant shift. Finally, for slide 5, the road ahead management's outlook and key takeaways.
All right, so the past quarter was strong, definitely impressive. What about looking forward? What's management saying about the road ahead? Are they feeling confident this momentum can actually continue?
They certainly sound confident, and their guidance reflects that. Management gave forecasts that suggest they expect this business momentum and the operational improvements to keep going. For Q3 of fiscal 2026, that's the current quarter they're in now, they expect revenue between $390 million and $395 million. And for the full fiscal year 2026, they're guiding for revenue between $1.571 million and $1.576 billion. So pretty solid numbers. It definitely suggests they see this continuing.
We also heard from the leadership, right? CEO Daniel Dines, he put the strong quarter down to improved execution and also the growing momentum of our agentic capabilities. Okay, agentic capabilities, that sounds AI-related. Techie, what does that actually mean for UiPath and their customers? Is it just a buzzword or is there real substance there?
That's a great pickup because it's a term you're likely hearing more in the AI world. Agentic capabilities basically means their software agents are getting smarter. They're moving beyond just automating simple, repetitive tasks based on a script. Now, these agents can make some decisions, adapt to changing situations, maybe even learn a bit on their own to achieve a goal. So for UiPath, it means their automation platform becomes more powerful, more proactive. It can handle more complex end-to-end business processes, not just the simple stuff. This is pretty critical for staying competitive in the AI and automation space. It allows them to deliver more value, more efficiency to their clients. And the CFO, Ashin Gupta, he also chipped in, noting these results position them well for the second half of the year. So it highlights this dual focus. Keep running the business efficiently, but also keep innovating, especially in this intelligent agentic automation area. Okay, so if we boil this whole deep dive down to the absolute key takeaways for you, the listener, here's what I think really matters. First, significant outperformance driven by efficiency. They crushed expectations, revenue, and especially EPS. And it wasn't just sales. It was powered by that huge jump in non-GAAP operating margin from 2% up to 17.2%. That's a massive efficiency gain. Second, the subscription model is the core profit engine. That high growth, plus 22.5%, high margin, 84% subscription business, it's working beautifully. It validates their whole SaaS model with professional services acting as that strategic loss leader to lock in the recurring revenue. Third, Fortress balance sheet enables shareholder returns. They've got over $1.5 billion in cash, very little debt. That strength allows them to buy back a lot of stock, signaling confidence and directly boosting your EPS. And finally, strong guidance suggests sustained momentum. Management's outlook for Q3 and the full year is positive. It indicates they expect these operational improvements and the business momentum to continue. They seem to have set a new, higher bar for performance.
Yeah, and that really brings us to an interesting point. This quarter, it feels like it could be a real turning point for UiPath. It pushes back against some older worries about their growth and maybe sets this new baseline. If they really have turned this corner, what does that signal maybe for the wider tech industry about the importance of, profitability and efficiency, not just growth at all costs?
And that's exactly why digging in like this is so valuable. It helps you, the listener, get past the headlines, see the why behind the numbers, check the financial health, understand what management is thinking. It's a way to build a much deeper understanding of any company you follow, not just looking at isolated numbers, but seeing the whole story unfold over time.
All right, now for a final thought for you to chew on. As companies like UiPath really show the power of getting efficient and having smart business models, how might that shift the focus across the tech world? Could we see investors start valuing sustainable, profitable growth more and maybe step back a bit from that old growth at any cost mantra? Something to think about for the coming years. Okay, just a quick reminder. This discussion is for informational purposes only. It's not financial, investment, legal, or tax advice. Always do your own research and talk to a qualified professional before making any investment decisions. And please note, this analysis was prepared with the help of AI, integrating company data and public market information. Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.